Okay, so first my disclaimer, which you have to do if you work in finance. Anything I'm talking about today is my personal view and not the view of my employer, right? So this is very important in finance to make sure that we're all aware about it. Then the outline of what I want to discuss today will be very basic, and again, please feel free to stop me at any time and ask me questions, right? Because it will make us more interactive. I don't want to do a lecture, and it's not actually the purpose of this class. It's the purpose to give you a bit of an insight about the industry and also hear your questions and hear your comments or whatever you would like to tell me. So I want to quickly go through different types of employees in wealth management, different types of roles. Again, maybe you already know this, but we will try to approach it like from a more practical point of view, like where do you try to get your next job or next internship, and which role is right for you. And then we can look at the different skills and competences which you need in this area. And then I will also share some of my experience, how it's different for me to work with the private clients compared to working with the institutional clients. You know what is different? Private clients, like in individuals, as I mentioned, people entrepreneurs who made money, but they don't know much about markets, and maybe they know a lot of their experience, but still it's not an institutional client, so they follow different logic, and their view of investments is totally different than a client of investment bank, for example, a big asset management firm. Okay? So, yeah. So why I'm putting this here, it seems very basic, right? So what are the employers to look at if you want to have a career in private wealth management? There's private banks, like similar to what I told you, like Citibank, JP Morgan, UBS. So there are big private banks, there are smaller banks, but you probably know a lot of them. There are wealth management firms, like in St. James's Place, for example, so you've heard about them as well. And there are single-family offices and multi-family offices. So what's the difference? The private banks and wealth management firms, they have a lot of different clients, right? And they manage their money, and they provide them investment advice and other different, and give them loans if they need to buy the yacht, or if they need to buy the private jet, they give them financing. So there's a different type of service. And then single family offices, it's on the client side. So basically the client wants to have several people who are his team, and they're helping him with administering the wealth and also working with the private banks or wealth management, so representing the client. Multi-family offices is usually similar to single-family offices, but will be several clients, several people who would have like an office set up, and these people will be helping with the investments. It will be a liquid investment, it will be private investments, private equity, private credit, whichever the client needs, anything related to the client's wealth management, and they also will be representing the client in front of the banks. So now your question, okay, if you want to have a career in this area, you're a student, you're looking for internship. Well, for internship it doesn't really matter. It's always good to get into the big bank, but if you didn't get to the big bank, it's fine. You can also try to do something which is at least related to wealth management, like multi-family office or wealth management firm. But for the main job after you graduated from the university, I strongly, and it's my view, I strongly recommend to go and try to get into the big bank. They have the analyst programs. An analyst program is good. It's usually 3 years. And it's good because in some banks you can have rotations, so you won't be within one team. You can be in different teams, and you will see different types of jobs. You can be in credit, you can be in structuring, so it will be different, right? But you will have a very good understanding of how the business works, and also a very good background. So for me, like when I mentor guys who are like in their early 20s and mid-20s, and they think how to get into the industry, I'd say, for me, either big bank or big asset management firm, analyst program is the best way. I know also people who are starting by joining single family offices and multi-family offices and growing there, but I still think that you can better learn in the big bank. Anything to ask here? Any questions? No? Everybody agrees? Okay, so what are the roles now? And here I'm covering the roles mainly from wealth management side, but you will see that in wealth management there are all very different roles. So the main person in wealth management is a banker or relationship manager. So this is the person who knows the clients, who brings the clients, right? So for this role, it usually should be the person who is already quite senior, very well connected, who developed connections through their previous work. For example, I've seen many people who work in investment banking and they achieve senior levels, for example, in M&A, and then they know people who are selling their businesses, and now they suddenly became with a lot of like several billion in cash, they know what to do, so they would be looking for a private bank, for wealth manager. So this type of career is quite straightforward. But also I've seen some people who became bankers by joining on the analyst level, and of course you're not joining as a banker, you're joining as an analyst banker, which is pretty much doing all the admin work and whatever the banker asks you to do, so it's a lot of very simple, boring stuff, but then they're able to grow and then become an associate and then become a VP and then eventually try to either manage some clients who are already in the business and try to go and look for clients in the industry. So there are different ways how you get to this role, but private banker is like the top role in wealth management. And then there is investment advisor. This is the role which I'm doing. I call it front office. Front office means that this is the client-facing role, right? Investment advisor, so for me, I don't have to go and look for clients, but my task is to make sure that the clients who are already in the business, they have their investment needs met, so I discuss with them their portfolios, I give them investment ideas, so anything related to investment side, this is the investment advisor. So again, how you get to this role, in the big banks, you start as an analyst. Again, you can be analyst in investment desk, and then you start growing, or you can work as a product specialist, or you can work in an asset management firm and then try to move into this role. So basically for investment advisor, the most important is you have to be very technical, but you also have to have soft skills, because you're working with the clients and you're working with the private clients. So you have to understand how the person feels about certain investments, how to explain it to them in the best way, never get upset or irritated if they don't understand or if they don't agree with your point of view. So you have to have like a very good mixture of soft skills and technical skills. These are front office roles. And for me, like I've been investment advisor both at Citi and at JP Morgan and in my current role. Okay, and then there are also different roles. Again, if you go into a big bank, as you mentioned, portfolio manager. So there are different strategies within the bank which are managed internally. So there will be portfolio managers, there will be product specialists. For example, there will be a person who knows about FX, right, currencies. So they will be only specializing in currencies, and they will be helping investment advisors and bankers if there's any requests from the clients in this particular area. Or product specialists in equities. Again, if there is a request from the clients and it's too specific for investment advisor to know the answer, they would go to the product specialist. So these roles, again, are also quite interesting, but they are less interactive. There's less interaction with the client. So it's more if you're analytical, you want to know about the markets, you want to do a lot of research, but you don't really need this in-person interaction with the clients, and this is the right role for you. But also I've seen people who are moving from product specialists to investment advisors at some point in their careers. And then there are also such roles as market strategists and people who will be invited to the conferences or to the client meetings and tell about their views, like what is our forecast for the next year, how the markets will develop, do we have a positive view on European equities, and so on. So they'll be talking about the views. So this is again one of the roles which you can consider if you're more into economics, macro level, right? And then there are also other supporting functions. Client support is somebody who's dealing with their clients more like administrative questions, or tax advisors. Compliance is also very important now in the industry, or credit specialists. So I haven't seen many people moving from this area to front office. So basically if you want a role as a banker or investment advisor, it's better to try to get into front office rather than here and then try to move. I've seen some cases when these people from client support move into the junior banker role, but it was more like an exception rather than a rule. So you have to understand where you're trying to get and then try to get an internship or an analyst role in this particular part of the business. Okay, anything to ask here? Any questions? No? Okay, so skills. Again, it's not all the skills which you need, right? But this is an example of what is actually expected from you. So, and I'm talking now from the point of view of the banker or investment advisor, so front office people. So technicals, you should be very good aware about the markets. You should know all the products, and again, you will not know them as deeply as the product specialist, but you should have understanding what derivatives are, like what is FX, different type of structured products, equities, bonds. So you have to be a generalist. So you have to know everything at a quite good level, right? And then if you need somebody with deeper knowledge, you will go to the specialist. And then with the soft skills, again, communication, you should be able to network because you need to look for the clients, like if it's a banker role. And then for the banker role, again, an investment advisor, you have to be trustworthy, so you have to follow professional standards because people trust you with their money, right? So you have to actually show that you can manage it and you're a prudent person. And then for investment advisor, again, if you're talking to the client who doesn't understand much about markets, you have to be able to explain complex concepts in a simple way. Right? And now it's probably the most interesting part for you. So I'm not saying these are required degrees or skills, right? But this is something which I've seen people usually have in this industry. So first of all, it's a graduate degree, right? So generally, finance, business, economics. Sometimes I see people with a quantitative background, but they would need to learn about the investments additionally. And then I've seen people a lot of people with MBAs, right? And the question is, people usually ask me, what would you do, an MBA or a CFA? In my case, I've done both, and I had my own reasons for this. And I would say they're different, right? So MBA, it's a more general program. It teaches you strategy, teaches you some finance, but not to the level as a CFA. But it also, it's good to have, and it's also a good network, and it looks also good on your CV. So I would say, if you want to do an MBA, aim for the top school, right? Something which is really worth the investment. And also another question, and then if you do CFA, then CFA is good for technical knowledge, but it's also good because you don't have to leave the job. So if you already have a job and you want to do a full-time MBA, then the problem is you have to leave this job. You go and do your MBA for a couple of years, and then you start everything from scratch because it's very difficult to get a job after the MBA. The competition is huge, and everybody is trying to get into the same banks, into the same employers. So if you already have a good job, I would say don't do full-time MBA. Either do a CFA or do part-time MBA, like evening or executive MBA at a later point in your life, because after a full-time program, it gets more and more difficult to get back to the industry. And then for CFAs, I already covered this. So they started this new private wealth management pathway. So if it's the area which you are looking at, then you can consider doing a CFA program. And I believe now it became less complicated because you no longer have to wait. If you failed it once, you no longer have to wait for the whole year. You can take the exam sooner. So this degree, I took it because I wanted to know about UK products. So again, if you want to be in wealth management and UK industry, this is the good degree to have. And then regulatory exams, your employer will tell you what you need to do. Right? So from your side, in order to get there, you have to have like a good graduate degree, and then think either MBA or CFA. But I've seen people who were quite successful even without having either MBA or CFA. They would have like a good master in finance, and then good communication skills, and they're able to progress even without this. So this is not necessary, but something to consider. Okay, so before we move to more general stuff about my observations of how you work with your private clients and how it's different from institutional clients, do you have any questions on the degrees or skills? Or yes, please.
Would you recommend any other postgrad studies that can help you break into wealth management?
Which one?
Besides MBA and CFA?
Oh, I don't really know about them. Like what I mentioned here, that's what I see in the industry. So most of the people either have an MBA or CFA or both, as in my case. But I don't really know what else exists. Yes, a gentleman behind you, then you. Yes.
I just have a question. So when you do, most of the big banks, don't they like offer to pay for your CFA or even your MBA? So is that a path to choose, or do you have to do it yourself and then?
Okay, so in big banks for CFA they usually pay. The employer usually pays. For MBA, I'm not sure. I don't think so, because MBAs, if you do LBS, for example, it's like it's very expensive. I don't think banks do it. But also, there is another thing now to remember. Because when I was doing my MBA, at that time, most of the banks, they would expect you to come as an analyst, to be there for 3 years, and then they would not progress you to associate. So they would expect you to, they say, okay, your analyst program is finished, you have to go and do your MBA and come back as an associate. So now, it's no longer the case. So what I saw in the industry, they started to giving path to the analyst, from analyst role to associate. Again, there are some, not everybody gets it, but it's different now. So at least if you got as an analyst somewhere in a good bank, you no longer have to leave after 3 years. You have a chance to become an associate, and then in this case, you can think, okay, I like this bank, I don't want to leave this job, but what else can I do part-time or in the evenings or during the weekends, and then it comes either to a CFA or a part-time MBA or executive MBA, right? So that's how it's different now in the industry. Okay, and then you had the question.
Oh yeah. Do you think there's a chance, like there's a point in applying straight from after bachelor's, or like you have to do MBA or master's?
No. You can apply after bachelor's, of course. Yes. Yes. No, because some people won't even do masters. Most will do masters, but yes, you have to apply, and then you can do masters part-time, like master in finance, for example. Yes.
Do you think it benefited you having work experience before doing the MBA?
Usually you have to have work experience before MBA, so at least at LBS it was a requirement. For executive MBAs, it should be like longer work experience and more senior levels. I don't remember what was the requirement for LBS, but I remember in my class, the average age was 27, 28, so people already had experience, like, I don't know, 6-5 years of experience.
Helena, do you have a view on doing a PhD? Do you have a PhD
Yes,
yourself?
I have
You
a
did in
PhD.
early age. Is it beneficiary
Yes.
in the industry or not?
Yes, so PhD, like as I mentioned at the beginning, so I had 2 separate careers and I always was doing lecturing as a part-time job. And so for me, it never was a full-time job. So it helped me when I moved to London because I was able to teach here. And generally it gave me like a better perspective, but in my current job, I don't need that. I don't need it. It's good to have, but it's the best use of it. It's either you do it in an academic career, or it can be, I don't know, PhD in engineering, like an MIT. So you're quant, you're very smart, and then you go into hedge funds and do the quantitative strategies, where you make a lot of money, but there it will be relevant. At least what I'm saying is from my experience, because I saw people who've done it and became successful quants in hedge funds industry. In wealth management, you don't need it. Yes? Okay. So should we move to the next part? This is just to entertain you a little bit, because I know I already probably talk about serious stuff a lot. So these are my observations. How is it different to work with private clients compared to institutional clients? And this is like what I saw in the industry. So usually, you know, if you're a manager in a mutual fund, right, or portfolio manager, you benchmark yourself to the index, right? So for example, you say S&P 500 is down minus 10% and I'm down only 7%. So I outperformed the index and I did great. It doesn't work with the private clients. They don't care where S&P is, they don't care if you did a bit better than S&P, they only care about absolute return. So you have to make money in all conditions, in all weather, and if you made it, let's say if they invested in fixed income or invested in European equities and S&P gave better return, they will start complaining that I should have invested in S&P instead of like being with you. So this is something to remember. They always want absolute return, right? So this is no benchmarking works and no reference to how the markets behave and so on, how the indices behave. It never works. Then they usually say, not all of them, but I've seen a case that people say, I have high risk tolerance. I'm a very aggressive investor. I want to make a lot of money. I don't care if market drops. I can withstand it. I'm fine. So it only works, and then of course you invest them this way. You discuss with them investments. They go aggressively in equities, some emerging markets, and so on. And then the correction starts, like you saw what happens today, right? In the market, markets are going down. It's not like a full correction, but it's still not very pleasant. So high tolerance ends when the market downturn starts. So once market starts crashing, they start panicking. They want to exit. They no longer can withstand the market downturn. I've seen some people who've been through several market corrections or several even financial crises, so they already learned and they are more relaxed about it. But generally, always question when people say that they're aggressive investors, because it will end when the market starts going down and people will start exiting at the wrong time. So you always have to be more on the conservative side. And then sell at the bottom and buy at the top, exactly opposite to what the institutional investor is learning to do. Like you in the classes, they told you that you have to buy cheap and you have to sell expensive. And for private clients and especially retail clients, like smaller clients, they would usually do the opposite. The market is running, they're afraid that they're missing out, so they start buying. Then the market drops, they're scared that they lost money, they start selling exactly at the wrong time. Or something to keep in mind. Then irrational emotional decisions, because we're human beings, and private clients is more relevant than for the institutional clients. I've seen some clients being quite overconfident in their ability to outperform the market, so they would select their own stocks, let's say Tesla or other stocks, and then they would say, no, I insist, I invest only in this, and I'll do better than S&P, and then a couple of years down the road, and everything crashes, they say, oh, yeah, well, we should have invested with the manager rather than our own stock picking, using our own stock picking abilities. And then the other thing is that usually, like there is a theory how you invest. So portfolio should be diversified, certain proportion should be in US equities, certain in European, certain in bonds. But some clients, they think European equities were not performing much. I won't be investing in European, I only invest in US tech. And now you see what is happening with US tech. So US tech is down, European equities rallied, oh, we missed the rally. So it's difficult. You have to always keep them diversified. And a couple of charts just to finish my talk. These are my favorite charts. So this one I borrowed from my previous employer, which you usually show to them, to the clients when you talking to them about investment. So many clients insist on staying in cash. So they have a lot of cash. It's safe. The cash is paying like 5%. Now they insist on staying in cash, so you have to show to them like long-term projection, historical, that this is the line is equities, this is fixed income, so always on the long run, equities and fixed income outperform cash, so this is cash. And then you explain, yes, there will be drawdowns, this will be volatile, but if you're a long-term investor and you don't need this money next year for something, then it's better to be invested in equities. So usually, this is the first educational point you start with. Then the second, you tell about volatility. So these orange dots here, they show, this is every year, right? So for example, to 22, it shows you orange dot is where the market was the biggest drop in the market, like 10%, for example, or minus 30%, and then the dark line is what the market returned at the year end. So volatility is normal, that's what you tell to the clients. There is no need to jump out when you see that the market is down 20% or 30% or 10%, because it's a good time to actually add to your portfolio, to buy, and then at the end, most of the years, like here the stats show that this is for 52 years. Out of 52 years, during 38 years, the returns, annual returns were positive, right? So if you got scared, if you exited at a low level, you lost money, but then you see that the market still recovered and everyone else made money. So this is the second, and this is the last one. Again, also helps to deal with people's biases, because clients often think that they can predict the market and they don't want to sit in the market if the market goes down, so they want to be in and out. Like, you know, frequency traders, it doesn't work this way. So this shows from 2004 until 2024 what happens if you stay invested, if you don't jump in and out of market in S&P 500. So average, you'll get 10% per year. So some years can be more, some years can be negative, but on average you get this. If you miss 10 best days, you only get 6%. If you missed 20 best days, you only get 3%, and if you missed 30 best days, you only get 1.4%. And the problem is that you never know when those best days will happen, right? So it's important to be invested, stay invested, rather than try to time the market. So these are three of my favorite charts, which I usually use to try to educate people to invest with the knowledge. Okay? So I think that's it from my side. Any questions?
Do you have any questions? So
Yes.
let me ask you a question. First of all, I'm very glad that you use the same slides that I do, okay, which are from JP Morgan. Of course, A Guide to the Market, which is a famous publication that JP Morgan brings every quarter, okay? And it's very useful, it's very educational, but it's also very practical, so I thank you for that. But with regards to constructing portfolios and advising clients, how do you do? Are you a 50-50 person? Are you 60-40 person? Or, you know what I mean? Like, how much do you put into equities versus bonds? Or use other investment strategies such as alternatives or private credit and so on? But you want to talk a little bit about that. Thank you.
Yeah, sure. So the first starting point is that you have to understand the client's risk profile, right? So
I like that. That's what I tell my
Yeah.
students here and the clients as well. Yeah.
Yeah, because you cannot do anything before you understand their risk profile. And some clients are conservative. In this case, it means that you can have a little bit of equities, like 15%, for example, but the rest should be in fixed income and maybe cash if they need cash at some point. The client says are moderate, and again, it's not that you ask them, you have to give them the questionnaire and actually make them to fill in to answer a lot of questions, based on which you define their risk profile. So it's not a straightforward process. Then, if it's a moderate, so medium risk profile, then it will be closer to, as you mentioned, 50-50 or 60-40, but it's not, right now it's not only equities and bonds, it will be also hedge funds, private equity, private credit. So for example, in my work, I usually rely on the models, like asset allocation models, which are done by our quant team, because they know, they run the models, and then you can give the best allocation. But generally, moderate, it's approximately, can be 60% in stocks, can be 50% in stocks, but there will be also like 10 or 15% in alternatives. And then there is a strategic asset allocation, tactical, so you can change it depending on the market conditions. And for aggressive investors, again, most will be in stocks, alternatives, private equity, private credit, smaller proportion into bonds. But in my case, I rely on the quant guys who actually give the allocation.
Thank you. Where do you see the greatest opportunities at the moment in the market?
Well,
Equities, bonds, hedge funds, private equity, something else, and then within this asset class, perhaps the sector. Don't to get best out of it, right? So,
well, first of all, I'm not providing investment advice.
I know it's not investment advice. It's your opinion. It's
Secondly, it's my own views and not the views of my employer.
yeah, it has nothing to do with your
It's very
employer.
clear.
Yeah.
Yes, and thirdly, you have to as I mentioned previously, have to be diversified. So you have to follow the strategy. So if you're a moderate investor, you take the asset allocation which is recommended, you diversify your investments, and you should have in your investments US equities, European equities, Japanese equities, a bit of emerging markets depending on your risk profile, private equity, private credit, and hedge funds. But there is no such way as you say, this is the biggest opportunity, this is the theme of the year, and I only invest there, because you may lose a lot of money. So what you have to do, you do the core portfolio, which is diversified based on your risk profile, and then you can do satellite investments. For example, you think if defense stocks rally, then they will, I'm giving an example, I'm not telling that this is what is happening, but some clients may think, okay, defense may rally further because there are a lot of investments in defense stocks. Let me add like thematic fund or ETF based on defense stocks. But the first starting point, you follow the science, you do your diversified portfolio, core portfolio, and then you start looking at different opportunities. Yes?
Any question? I
Yeah.
can give it to you as a question.
Oh, yeah. So you said that private investors tend to prefer absolute returns rather than relative performance. So how do you address that? Like,
Well, it's always an ongoing negotiation and ongoing conversation, because you do portfolio reviews every quarter, or sometimes even sooner, like every month if the clients are more proactive and they want to see about how the portfolio performs. But you still try to explain that you have to be diversified, and this quarter, unfortunately, European stocks underperformed or US stocks underperformed, and that's why your return is not as good. But if you only invested in US stocks, you taking the risk that you will miss the rally in other asset classes. It's always a conversation, and again, absolute returns, you can look at hedge funds which do absolute returns, but their strategies would only return like 5%. So it's not what the client wants, they actually want big absolute returns. So it's always a conversation, but it's something which you have to remember and to pay attention to, because that's something which clients always bring when they look at how their portfolio performed.
Any other question? Last opportunity. Dimitri, I think go ahead.
yeah, just if you see like in the industry, what programming language do you see people around you using? Like, because like I was gonna start studying R, but then I hear it like Python is very popular, so like, I don't know if.
I know my previous employer, the people are doing Python. Right now, it's probably been like a couple of years, so I'm not sure which one is best, because I'm not a quant, so I'm not really following. So in my case, I only use basic Excel, so I don't really need like programming for my job. So it's better probably to speak to somebody who's in quant area to discuss this.
Thank you so much. Any other question? If we have no other questions, then a round of applause for Helena.